Okay, welcome back to the second part of our conversation regarding the price to book value metric. And so before I dive into the body of this episode, I do want to first kind of leave you or start you off with a quick metaphor. And just like the way you wouldn't dig a ditch with a hammer, you probably wouldn't want to utilize the price to book value metric for all stocks across all industries. It's just you're not utilizing the right instrument. And so you're going to have to utilize this particular metric with a certain level of nuance, a certain level of fluidity in terms of being able to understand what are the shortcomings of this metric. And so we're going to discuss that right now. Okay, so as I was saying, the price to book metric, it's not going to be all too informative to investors when you're analyzing companies that don't have large financial assets like stocks or bonds or loans, or companies that operate with huge fixed assets, and where those fixed assets represent the substantial majority of the assets on the balance sheet. One thing I want you to remind you of is that book value is the asset value of the business represented at cost, minusing out all total liabilities. And so you're looking at the net residual value of a business on a cost basis, not at market value. So, and like I said in the first or in the earlier episode, being able to establish that dichotomy and recognizing the difference between book value versus market value is a very key thing to be aware of. Okay, so the only exception about this accounting rule of treating substantially most assets on a cost basis is financial assets. Financial assets are what is called marked to market. And that's kind of just the accounting jargon to be able to say, okay, these groupings of assets, since there's a quotable marketplace to be able to price these assets, it's going to be marked or adjusted to reflect the market value of those underlying assets. So let's just hypothetically say on a balance sheet, a company owns, let's say, one share of Netflix. If Netflix is trading at $375 a share on the balance sheet, it's going to reflect on the date of recording where Netflix's price is trading at. That's not the way fixed assets are typically treated on the balance sheet. Fixed assets are typically treated as if it's an asset that degrades and depreciates over time. So if I had bought a truck and that's going to be capitalized on the balance sheet, and I bought that truck for, let's say, $500, well, it's going to be valued on the balance sheet at $500, netting out accumulated depreciation and amortization of that particular asset. So it's not going to reflect the true market value of that asset. Case in point, another great example is real estate. If I bought a piece of real estate, yes, there is going to be physical wear and tear over time, but real estate, like we all know, there are upswings and downswings in that asset. And so on the during periods of time where real estate prices are increasing, the value of that real estate on the balance sheet is going to be recorded at cost, not at the market value. And so a lot of fixed assets are going to be treated very differently from financial assets or financial investments on the balance sheet. And so that's why it makes a lot more sense to be able to value certain financial companies from the price to book value metric. Whereas, say, like a Boeing, it doesn't really make sense, or it's going to be less informative to investors to look at that company through the price to book lens. And I think it's actually part of the reason why Warren Buffett disclosed in his most recent annual letter to shareholders that he's not going to use the year-over-year change in book value per share relative to the total return in the S&P 500 as a performance indication of his company. He actually went ahead and said this, or rather wrote this in the letter. He states, for nearly 3 decades, the initial paragraph of the annual letter featured the percentage change in Berkshire's per share book value. It's now time to abandon that practice. Berkshire has morphed from a company whose assets are concentrated in marketable securities or marketable stocks into one whose major value resides in operating businesses. So if you actually go ahead and dig into Berkshire's 10K, 2018 10K, you'll find that its investment portfolio, including cash, represents roughly about 45% of the total assets of the business. So the majority of the assets of the business are not these financial securities, and you can kind of understand why Warren Buffett would want to step away from the price to book, or rather the book value per share, as some indication of the intrinsic worth of the business. That's because book value isn't going to mimic or isn't going to reflect the economic reality of a business at all times. It will do so when the vast majority of the assets are marketable or has some quotable market to be able to reference as the underlying value of those assets. So given the fact that most of Buffett's company is the assets are not quotable, it's going to become very difficult to be able to utilize the book value as some gauge of the intrinsic worth of that business. So on the flip side, actually, it makes a lot of sense to employ the price to book value metric when you're looking at companies where the substantial majority of the assets or a large portion of the assets are devoted to financial investments. So think insurance companies, commercial banks, holding companies that have enormous equity interests in other publicly traded companies. Because of the fact that the composition of their assets are going to be comprised of financial securities, well, there's a quotable market for their underlying assets. And so since you can actually quote the value of those assets, you can probably arrive at the conclusion and understand that price to book value is going to be a good way of valuing those businesses. Now, for those of you who have some experience under your belt, who have been around the financial markets over the last 10-15 years, I think the moment I referenced commercial banks, you probably had a red flag go off, because you remember the 2007-2008 financial crisis. And that's where a lot of banks had really a lot of toxic mortgages on their books, and ultimately we know the aftermath of that financial crisis. And I think what you could extrapolate is sometimes, banks' book values doesn't mean anything. There's nothing on the books, or it's just toxic assets that are utterly valueless that are in the books, and that's a totally legitimate claim. If you can be that granular in your research and being able to identify, okay, are the assets on your books for this commercial bank, do they really have any value at all? That's a really astute way of going about valuing commercial banks, and but that's a legitimate flaw about this particular metric, and I think that really kind of underpins the flaws of accounting overall in the United States. But that's a totally different conversation. And I think, in short, I think book value nonetheless is still going to be a useful proxy of value for commercial banks during the normal course of business, eliminating or excluding these really outlier, extraordinary events. So, if you take a quick look at insurance company AIG's balance sheet, as of fiscal year 2018, I think about 64% of their total assets were composed of financial instruments, financial investments, probably composed primarily of some mixture of bonds. And so, because of that fact, that's why insurance companies can be observed under the price to book lens. And so, because the substantial majority of the assets are marketable securities. Moving on, I kind of want to highlight one interesting thing, and that's the fact that if you use the price to book value metric in tandem with return on equity, that could yield some really interesting insights on a particular company that you're analyzing. So say you come across a company that's trading at 0.5 times book value, or 50% of the book value of the company, and it's generating this really unappealing return on equity of 10%. Well, you have to kind of ask yourself, what is the effective return on equity, or ROE, of that business after considering the price that you're paying? Well, it's actually 20%. You're getting a 20% ROE business because of the price level you're paying. So let's just kind of unpack that math a little bit more and try to help clarify what I mean by there. Let's say you come across a company that has an equity value of $100, and on that $100, it's generating $10 in profits, net income. And so ROE right there is 10%. Now, like I said in the scenario before, let's just say that it's being offered for sale for 50% of book value. So you can buy the equity of that business for $50 as opposed to the accounting book value of $100. So the company's still going to generate $10 in profit. So what's the effective ROE after considering the price that you're going to have to pay? Well, it's 10 divided by 50, which equals an effective ROE of 20%. So that's why when you employ price to book value in tandem with ROE, you can get to a more effective ROE calculation that is going to be more informative to you as an investor. So let's look at an alternative situation, right? Let's say you have a really hot stock right in front of you, and the company is really, really productive on its base of assets or base of equity. And let's say it generates an ROE of 75%. That's really exceptional. But because it's a hot stock, it's a growth stock, the valuation is quite high, and it's trading at 20 times book value. So what's the effective ROE after considering the price that you have to pay? Well, it's 75 divided by 20, which equals 3.75%. That's in contrast to, say, other alternative rates of returns on safer assets, say like bonds or treasury bills. 10-year treasury bills, I think, are generating like 2.4% yield. AAA rated bonds, I'm sure, generate some premium to that. And so, that effective ROE, it's not really all that appealing. So, utilizing both these metrics together is going to be really helpful for investors when they're making investment decisions. Okay, so with that being said, I'm kind of rounding out the series or conversation around stock valuation. But the one, I think, principle that I really, really want to hit home to you guys is that you have, and I said it in the beginning, you have to be nuanced. You have to be fluid in terms of being able to employ these valuation metrics. And I think Bruce Lee, the Oracle of the East, said it best.
Be formless, shapeless, like water. Now, water can flow or it can crash. Be water, my friend.
In other words, what I'm trying to say is that context really does matter. So before I end this conversation regarding the price to book value and the net asset value of companies, I think I really wanted to end this series regarding stock valuation with price to book, because I think it's the perfect segue into the next stock that I want to talk about. And it's going to be NL Industries, ticker symbol NL, largely because I think there's an anomaly there regarding their asset value. And I wanted to bring it to your attention in the next episode. So look out for that. So, in this episode, if you found, or in these previous two episodes, if you found something that was quite interesting, you've never seen before, you learned something new, we'd really appreciate it if you hit the subscribe button and let your friends know that this resource is there, and give us a like. So with that, I guess I'll see you guys in the next episode, and where we'll unpack another stock. All right, have a good night, guys. I'll talk to you later. Bye.